This week, the Reserve Bank of Australia hiked interest rates for the 5th time in just 5 months. To say this is going to hit the Australian housing market hard would be an understatement. We've now gone from an official interest rate of 0.1% to 2.35% in under 6 months. Considering Australia has one of the highest leverage rates into housing, there's going to be big trouble ahead. Big trouble in little Australia. I'm Biko Konstantinos, and that's what we're going to talk about today. If you want all your dreams to come true in the next 90 seconds, make sure you like this video. And if you love freedom, like this horse does, make sure you subscribe to my channel. I'm Aussie and I've got a receding hairline. Now let's see how that pesky RBA is going to collapse the Australian housing market. Here's a snapshot of the official Australian interest rates. Pre-COVID, we were sitting at 1.5%. Then when COVID hit, interest rates were dropped to 0.1%. But check out what's happened in the last 5 months. They've gone straight up. Now let's check out the interest rates over a longer time span. In the early 90s, interest rates were dropping from super high levels. And after they dropped, official rates ranged between 5% and around 7% throughout the 90s and the early 2000s. So they were rising close to 7%, but then the global financial crisis hit and they were dropped to 3%. And after that, they kept dropping in Australia to super low levels even before COVID. Personally, I think these drops here were unwarranted, and what it's done is created massive speculation in Australia, especially for the housing market. When there's too much cheap and easy money, people will automatically borrow more and speculation increases. And the proof is in the pudding. Australia's housing market is extremely speculative and housing affordability is the worst it's ever been. So when we look at this recent rise over the last 5 months, in comparison to the bigger picture, it's still actually relatively very low. The average is more around 5% official interest rates, and at that level, variable mortgage rates would be sitting around 7.5%, which is way higher than the 2% mortgage rates we saw in the aftermath of COVID. To get a feel for where interest rates could be headed from here, let's check out this latest statement by Reserve Bank Governor Philip Lowe. The board is committed to returning inflation to the 2 to 3% range over time. The path to achieving this balance is a narrow one and clouded in uncertainty, not least because of global developments. He goes on to say that the outlook for global economic growth has deteriorated. Inflation in Australia is at its highest it's been since the early 1990s and is expected to increase further over the months ahead. And here Lowe acknowledges that domestic factors are playing a part. He expects inflation to peak this year before starting to decline. The bank is forecasting for CPI inflation to be around 7.75% in 2022, a little over 4% in 2023, and 3% over 2024. Here's a representation of that forecast. CPI inflation is currently sitting around here, and the RBA expects it to peak around about this 7.75% before starting to decline over 2023-2024. At 3%, CPI inflation would be in the RBA's target of 2 to 3% inflation. Do you agree with their forecast? The statement ends with this. The board expects to increase interest rates further over the months ahead, but it's not on a preset path. The size and timing of future interest rate increases will be guided by the incoming data and the board's assessment of the outlook for inflation in the labour market. The board is committed to doing what is necessary to ensure that inflation in Australia returns to target over time. So what does this latest statement tell us? It tells us that inflation in Australia is way above the 2 to 3% target. It reveals there's some major global economic challenges ahead, and it tells us there's going to be further interest rate increases, and the Reserve Bank is committed to reducing inflation to those target levels. Now contrast this latest statement we just went through with the messages the RBA was giving in 2021. The board will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. For this to occur, wages growth will have to be materially higher than it is currently. This will require significant gains in employment and a return to a tight labour market. The board does not expect these conditions to be met until 2024 at the earliest. I mean, come on, man. What a statement from a central bank. So in 2001, they provided an expectation that they didn't think interest rates would need to rise until 2024. Guess what, Philip Lowe? It's now 2022 and we've seen 5 interest rate hikes in 5 months. I mean, no one's gotten it this wrong since the final season of Game of Thrones. Now, interest rate hikes aren't really a problem unless you have debt. So how's Australia's debt fare? Looking at household debt relative to household income, we can see that Australia, along with Canada, are the highest in the world. According to this article from Livewire, debt levels in Australia have gone from the bottom of global countries to now near the top. In 1990, there was an average of 69 household debt for every 100 of income. But today, it's $187 of debt for every 100 bucks. So what's driven this massive rise in debt? Financial deregulation made debt more available. Progressively lower interest rates made debt more affordable. Attitudes towards debt have become much more relaxed as we haven't had any wars or major depressions. And rising debt means homebuyers have been able to pay more for property, which means property prices go up and you need more and more debt to get into property. Now, this article points out that rising wealth has been increasing higher than debt. But in Australia, the vast majority of that wealth is due to rising house prices. And what would happen if those house prices dropped quite suddenly? You'd have a very sharp loss of wealth. So what about mortgages? The total value of owner-occupied home loans in Australia in July 2022 was $17.31 billion. And the average home loan size is now $609,000. This black line here shows how the average mortgage was around $200,000 in early 2000s, but continued to climb and now sits around this $600,000 level. Now, 67% or 9.8 million households are homeowners in Australia. Out of that 67%, 32% don't have any mortgage and 35% have a mortgage. So more than half of householders have a mortgage, and all those mortgage holders combined have an average of $600,000 mortgage. So as a result, Australia is a very indebted nation, and because of that, the impact of rising interest rates will be much more severe. So we've got super high levels of debt. Interest rates have risen very sharply with more to come. So all this is a recipe for disaster. Now, the big factor is how high interest rates will end up, and will they stay at that level or will they start to come down? Variable mortgage rates are typically around 2.5% or 3% higher than the official interest rate. So if the current official interest rate of 2.35% rises to around 3%, we'll see variable mortgage rates of around 5.5 or 6%. So on a $1 million loan, you'd be paying 55 or 60% just interest without actually paying down the loan. And as crazy as it might sound, $1 million mortgages are getting more and more common, especially in places like Sydney, where the average home is around 1.6 million. So more and more homeowners will be getting into mortgage stress, which is normally defined by paying over 30% of your household income towards the mortgage. Now, we might see some distressed selling of houses, but the bigger factor, in my opinion, is reduced borrowing capacity. In other words, the maximum that the banks will allow you to loan will be significantly reduced as interest rates rise. Now, along with the sharp interest rate surge we've seen lately, banks add a serviceability buffer when they assess your loan. Currently, this serviceability buffer is 3%. At their lowest rates, variable mortgages were sitting around 2%. So the banks add their 3% buffer and then they offer you a loan based on your ability to repay at 5%. So now we're at 2.35% official interest rates, and with more to come, we could easily see a 3% official interest rate. That would take variable mortgages to around about 5.5%, and when you add the 3% buffer, that takes you to 8.5%. So when the banks assess your ability to repay at 8.5%, they're going to offer you a lot lower loan to make sure that you can repay that amount. And when people can't loan as much, they can't offer as much, and what happens? House prices fall. These interest rate hikes are going to cause havoc to the Australian housing market, but that's only because we've allowed so much speculation because interest rates were so low for so long. But it's happening now, and we have to consider the possibilities. Best case scenario, inflation starts to reduce quite rapidly, falls down to 2 or 3%, which is the target levels, and then interest rates can stabilize or maybe even come down a little. Worst case scenario, inflation remains stubbornly high, so interest rates have to remain elevated for a considerable period. This puts pressure on businesses, which causes continued falls in the stock market. House prices continue to fall. Everyone starts freaking out and being very careful with their money. This causes the economy to go backwards or in a recession. Unemployment starts to rise, which increases the number of distressed selling of houses, which accelerates falls and leads to a crash. Now, my view falls somewhere in the middle. I think house prices were just far too artificially inflated by cheap and easy money. So now we're prone to larger falls because interest rates have to be surged. And because of the massive amount of debts in Australia, these higher rates, even though they're not historically high, are gonna hit hard. I'm Biko Konstantinos.